generally when you get to baseball season and spring begins to sprung, right? You get people who get in better moods. But the stock market certainly isn't. 5 of the last 6 weeks have been down. Gold hits a new high, and a lot of stagflation talk.
There really is, and this week didn't really help with that stagflation talk. If we just look at the data release on Friday morning, we got the personal spending and income data, and along with that comes the Fed's preferred measure of inflation, the PCE inflation. That's personal consumption expenditures for those playing along at home. And that, I think, really contributed to some of these fears that we're going through a little bit of a slowdown. There was a nice jump in personal income, but most of that came from government transfers and not necessarily from compensation and wages.
So let's explain it, because that's really good stuff. So the PCE, what is the Fed likes as that's their inflation indicator. Yep. So if it's up 0.4, you annualize that 4.8%. There's some people saying we might look at a 5% inflation number. That's the part of the inflation, the stagflation.
Yep.
The second part is, you said it looks like a slowdown. That's the stagnant economy. You put those two words together and you get stagflation, which is slower growth and higher inflation, and that's bumming people out.
It really is, especially since the Fed is almost like they don't know what to do with that, because with the high inflation or higher inflation, they don't necessarily want to cut rates, but if you see the stagnation part of that, then they would want to. So it really kind of binds their hands here when you go through this type of environment. If you remember back to the late 1970s, early 1980s with Paul Volcker, he decided, okay, well, I need to focus on the inflation part of the Fed's mandate, since he really couldn't do anything, he thought, about the stagnation part. And I think that this past week, we look at the PCE data, it is still positive. So yes, it is a slowdown in growth, but excluding government transfers, real income still rose 0.1% for the month. That's not great, but it's not horrible. So it hasn't dipped into negative territory yet.
I love your attempt at finding the silver lining, and that really is. But we look at the trade imbalance and really that GDP report, and the Atlanta Fed still keeps it in a negative territory.
They do, and they made an adjustment to their model for their real-time reading of GDP, because a couple of the import indices that we got, they've been distorted by gold imports. So people wanting to get ahead of possible tariffs bring the gold bars from Switzerland or the United Kingdom to the United States. And the Atlanta Fed, they realized that that was distorting that number, so they made an adjustment. And with this most recent income data that we got, though, it has dipped back down to negative 0.5%. Earlier...
And that's important because...
Yeah, because if you... a recession is 2 quarters in a row of negative GDP. And so if we have a first quarter GDP number that's negative 0.5%, if you get another one, then people are going to be like, okay, I guess it was a recession. And
therefore, and I don't mean to jump in, but if it is a recession and those percentages are going up, there's still less than 50%, far less than 50% that happens. But if you get those back-to-back numbers, the market is going to have to adjust to that.
That's right.
Because generally we have bear markets and recessions generally walk hand in hand.
That's right, because what we've seen in the data going back to 1950 with the about 45 bear markets and corrections, so a correction, a 10% decline or worse, a bear market would be 20% or worse. Most of those bear markets, the 20%, were during recessions, the early part. So the market would oftentimes find a bottom in the early part of the recession, but that would, I think, confirm that idea. Right now, it's just the fear of a recession. If the fear becomes a reality, that means the market correction that we've been going through could turn into a bear market. That's not our base case scenario, though. We always have to think about the scenarios looking ahead. What's the base case, the most probable? And then think about, well, what if I'm wrong? In terms of, am I too pessimistic? Am I too optimistic? So you develop a bear case and a bull case scenario. We still look at that base case of this is just a soft patch that we will get through, but the odds of that bear case scenario have increased a little bit just because of the data, the way that it's been rolling in.
So I still want to get to 2 points. April 2nd coming up is Liberation Day.
That's right.
And that is really the day that these tariffs are supposed to go in. We still don't know if negotiating will happen. We've seen some countries come to the table, Vietnam, for example, and said we'll make some adjustments. We'll see if that happens in Europe. So let's pay attention to April 2nd. That's a big deal. And then the second thing you just pointed out, and I don't want people to miss that, expectations of a slowdown, that means that people stop spending, and that is really how you get into a recession.
That's right. It can become a self-fulfilling prophecy where if people's expectations are negative enough, they pull back on spending, and then it causes the actual economic activity to fall. And in a way, what we have seen is consumers' expectations falling, and I think more importantly, business expectations falling, because consumers, they can say that they're feeling kind of glum but still go out and spend. But when it's those CEO surveys, so chief executive officers, their surveys, the chief financial officer, their surveys, when they get too pessimistic, they actually do pull back on those capital expenditure plans. I don't think we're at the point yet where I'm worried about a recession, but it is unfortunately heading in that direction.
Folks, this is the time really that you have to make sure that if we have a downturn, that you are prepared for that. And that goes through the process of looking at your portfolio and making sure it aligns with your financial plan. Folks, we do this on a daily basis through all of our branches.